Hello, Richard Herford here. Just looking at a pattern which is quite interesting on gold. Um, it's the 3rd of February 2010, and what's interesting is these two lines which I've drawn on the graph connecting the highs and the low points on this graph. This is a weekly chart running over a number of years. And the pattern formation which we can see here is termed a rising wedge. And what's interesting is that the price data is getting squeezed into this finer channel here. And if eventually we get a breakout, and it actually is to the downside, in other words, it finishes below this rising line, then this would be a breakdown of the rising wedge. This is a very similar pattern that was experienced in the stock market or equity markets before the crash. You can also see on there's a rising wedge shape, and the breakdown through the lower rising um, line obviously signified the start of that huge bear market correction. The corrections out of these rising wedges can be anywhere between a sort of medium correction, but at their extreme, um, we could see a major downtrend in the gold price, which actually could come down to around these levels again, which are around the sort of 700, 750 mark. If the data actually breaks through this line to the upside, then obviously we'll see some continuation of the rising price in the gold. But it's getting quite interesting now because the amount of space now left in this rising wedge is beginning to narrow, and we should see some sort of result coming pretty soon. So keep your eyes peeled on gold. If you get this break through this line, then maybe looking at short positions there. If you get a break through this top line, then be looking at you know taking out some long bull positions. That's Richard Herford from StockMarketTodayOnline.com. Thank you.